Good morning, and welcome to today's webcast, Navigating Stock-Based Compensation, IFRS versus US GAAP. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and with that, I'll turn it over to Mark Hedelund to get the presentation started. Mark?
Excellent. Thanks, Chad. Good morning or good afternoon, everyone, and welcome to today's webcast, Navigating Stock-Based Compensation, IFRS versus US GAAP. My name is Mark Hedelund, and I specialize in financial reporting within equity-based compensation. Throughout my career, I've worked extensively with clients to implement financial reporting for stock-based compensation, especially in the area of deferred tax assets. While my specialty is as a data and business analyst, helping my clients gain efficiencies using technology in their financial reporting processes surrounding equity-based compensation. One of the key factors in the success of my projects has been the guidance and collaboration with the accounting and tax specialists who are deeply familiar with the regulations we'll be discussing today. 2 of those specialists are here today, Ovanes and Dave. Ovanes, would you like to introduce yourself?
Thanks, Dave. My name is Ovanes. I'm a director in our technical accounting consulting practice. In terms of background, I have over a decade of audit experience auditing both private and publicly traded companies. And at some point, I just discovered that I enjoy more the accounting side than the audit side of things. And ever since, I've been doing consulting on anything that's technically challenging or complex. Certainly share-based compensation expense. We do a lot of accounting position papers for our clients, whether it's stock option repricings or sometimes just determination of the grant date, if they have new equity plan, how to account for their performance-based awards and so forth. But we would also assist clients with just any other technical accounting topic, whether it's business combinations, debt modifications, and we certainly spend a lot of time on IPO readiness engagements as well. In some cases, those would include kind of conversions from IFRS to US GAAP as well. That's on my side, and I'll turn it over to Dave now.
Good afternoon, everyone. My name is David Antoni, and I am a National Tax Managing Director leading Moss Adams Accounting for Income Tax Group, where I specialized in ASC 740 under US GAAP and IAS 12 under IFRS, working with our audit and tax teams throughout our practice throughout the country as well as our accounting consulting groups on accounting for income tax matters. I specialize in both complex multinationals as well as domestic entities on their accounting for income tax matters, including share-based payments, which is the topic for today. So thank you very much and hope you enjoy the presentation.
Excellent. Thank you, Ovanes and Dave. And before I proceed, I did want to welcome also our certified equity professionals in the call. Just to let you know, this session will be available also for you in the CEPI Connect portal after the session is over. So now that we've had a chance to introduce ourselves, let's dive into the content of today's session. As mentioned, even though there hasn't been much recent progress in the convergence between IFRS and US GAAP, understanding the differences between the two remains crucial for companies operating globally, and that's why we're discussing this topic today. So taking a look at today's objective on the left, describe the fundamental principles of stock-based compensation under GAAP and IFRS. Think of a company that offers stock options to its employees as part of their compensation package. Understanding the principles under IFRS and US GAAP is essential for determining how those stock options will be recorded in the company's financial statements, especially if the company operates in multiple countries. The second objective is explain how stock-based compensation expenses are recognized and measured under IFRS and US GAAP, including their key differences. Another example is, let's say an employee earns stock options that vest over time. Under US GAAP, and you'll find out, companies might recognize the cost of those options equally over several years. In contrast, IFRS requires companies to recognize more of that expense in the earlier years. Understanding this timing difference can impact how financials are reported and viewed by the stakeholders. And then 3, analyze how deferred tax assets related to stock-based compensation are accounted for under IFRS and US GAAP, and identify the main differences in treatment. So when an employee exercises stock options, this can create tax benefits or liabilities for the company. IFRS and US GAAP handle these tax impacts differently, and it's important to understand how deferred tax assets will affect the company's bottom line when stock options are involved. And finally, we'll try to outline key considerations for implementing and processing data for stock-based compensation plans under both IFRS and US GAAP. So if you're a company rolling out stock-based compensation plans across multiple countries, you need to collect and manage this data on who's receiving the options, how they are vested, and how the financial impact is recorded. This is where technology plays a role, as it helps streamline the reporting and ensures compliance with both IFRS and US GAAP. So just a little bit of background. The story of IFRS really begins in the aftermath of World War II, when countries around the world were becoming more interconnected and business started operating across borders more than ever before. As international trade grew, it became clear that having different accounting standards in every country created significant challenge for businesses and investors trying to compare financial statements from different regions. In response to this, the International Accounting Standards Committee, that's a mouthful, or ISC, was formed in 1973, as shown here, to create the common set of accounting standards. Over time, the ISC evolved into the International Accounting Standards Board, which in 2001 launched IFRS, or International Financial Reporting Standards. These standards aim to provide a consistent global framework for companies to report their financial information, making it easier for investors to make decisions based on clear and comparable data. Today, IFRS is used in over 140 countries, but the US continues to follow its own accounting standards, US GAAPs. Despite efforts to converge the two, significant differences remain, and that's why understanding these differences is so important for businesses that operate internationally. As businesses continue to expand internationally, the need to report under both IFRS and US GAAP becomes more important. Just looking at the list we provided here, an example is a US-based company expanding into Europe might need to comply with IFRS reporting standards to meet local regulations. Similarly, presenting financial statements in IFRS can be a strategic move for US companies seeking to attract international investors who are often more familiar with IFRS than US GAAP. This especially is relevant in the case of mergers and acquisitions. If a company acquires a European firm, aligning financial reporting through IFRS can streamline the integration process and avoid discrepancies in how assets and liabilities are valued across reporting frameworks. While convergence between US GAAP and IFRS has been slow, The importance of understanding both standards remain critical because global companies still need to navigate and reconcile the differences between them. This knowledge can lead to smoother operations, fewer compliance issues, and better financial transparency. Now I'll turn it over to Chad to take us on our first polling question.
Awesome. Thank you, Mark. And our first polling question of the day: which scenarios could potentially require an entity to either report under both US GAAP and IFRS or transition from one financial reporting framework to another? Either A, foreign issuer loses a foreign private issuer status; B, a private parent entity which has debt financing in the US and consolidated foreign subsidiaries subject to statutory audit requirements; C, a US entity that wants to raise capital in a foreign market; or D, all of the above. So if you select the answer on your screen and hit the submit button, your polling question will be recorded today. I'll give you about 10 to 15 seconds to answer this one. All right, we're at about 80%, about 5 more seconds here. All right, let's check out the results for this polling question.
And, all of the above is definitely the correct answer here. I think in terms of, I'm not surprised to see that, B came out as the highest, I think at 14%. We definitely see a lot of international companies that have foreign subsidiaries, and those foreign subs are subject to statutory audits in those local countries. Now, there's even additional complexity in that area as well, because sometimes those local subsidiaries, they may not be under IFRS, they might be under, UK GAAP or Dutch GAAP. But having said that, usually those local, generally accepted accounting principles are fairly closely aligned with IFRS. I mean, the differences, for example, between UK GAAP and IFRS are very minimal, and it's mostly related to kind of less burdensome disclosures for smaller companies. So really kind of more scaled down disclosure, but the actual underlying accounting is substantially the same between the two. Definitely much more closely aligned than versus US GAAP and IFRS, kind of those differences. Okay. Now, on the next few slides, we're going to talk about some of the major differences in accounting between IFRS and US GAAP as it relates to share-based compensation expense. I just want to mention, we have limited time for this presentation. This is not meant to be kind of an all-inclusive checklist of every single difference. But the ones that we kind of pulled out for this presentation really are some of the more significant ones, which we think have the biggest impact in terms of both numerical and significance in terms of your financial statements. Of course, number one would be the recognition method. As you all know, under US GAAP, you have an election to make whether you can do straight line recognition of compensation expense, or you can recognize compensation using the accelerated method. What really the accelerated method is, kind of what we're talking about here is, think about your, stock options with graded vesting. We're talking about employee awards that vest on a service condition. So if you have graded vesting, let's say a plain vanilla option, that would be that 4-year term, 25% the first year, 1% thereafter. That's a very common plain vanilla stock option. When you have graded vesting, each vesting tranche could be viewed as a separate award. And instead of having one award, you could actually have, say, 37, individual separate awards. The first award for 25%, and those 1% increments, each one being a separate award. And if you think about, if you treat those awards as being separate, and you try to recognize compensation expense separately for those, that, the first award vests over 1 year, but the second award vests over a year and 1 month, the third award over 1 year and 2 months. And if you start treating them as separate awards, you start recognizing comp expense for all those different vesting tranches immediately. So the reason why it's called the accelerated method, it's really, you end up recognizing more compensation expense because you treat all of them separate awards and you start doing kind of that recognition for all those multiple awards at the beginning. Under IFRS, you don't have this optionality. The use of the accelerated method is required. That means you are treating the awards as effectively being separate multiple awards, using their own separate expected lives for each vesting tranche. Now, when it comes to kind of some implementation considerations, kind of, a lot of questions arise as it relates to, should I align my US GAAP to IFRS so I don't have these differences in financial reporting? There are really a lot of different considerations to make. We listed out some of the key ones here that may be definitely important to consider when you're going through kind of all of the elections, and if you're trying to decide whether you want to align those as much as possible. First of all, obviously, it's the different amount of compensation expense, straight line versus accelerated, depending on what stage your awards are in. You may have more or less compensation expense. Is that important to your financial statements? I mean, it hits your net income. And for private equity owned businesses, it might not be as relevant because it's an EBITDA add back because it's non-cash. But that's definitely something to think about. For some companies, they may be doing manual spreadsheets, calculating US GAAP using manual spreadsheets. And that works okay in some cases when you don't have too many awards. They're not too complicated under US GAAP. But think about it, under IFRS, if you have a US GAAP spreadsheet with 1,000 grants, that manual spreadsheet can turn from 1,000 lines to 37,000 lines pretty quickly under IFRS because you're treating them as multiple awards. Your spreadsheets could become very cumbersome and slow, especially if you're trying to manually calculate the disclosures. So just something to keep in mind, IFRS is a lot harder to do manually than US GAAP is. Because of that fact that you're treating them as multiple awards, you have multiple line items for each and every single award. Also, another consideration is what's your existing capability of, if you're using a software and not using Excel, what's the capability of your current software? Does that handle both frameworks, US GAAP and IFRS? And also, a lot of software packages, they advertise that they can handle IFRS or US GAAP, but they may not have all of the functionalities to make that alignment possible. Or they may have certain limited functionalities where it may be difficult to use them. I mean, I know we had some projects where we worked on some very major, kind of very popular software that had very limited functionality when it came to stock option repricings under IFRS. And our client had a lot of stock option repricings. They had underwater options. So that was really important to them, that having that functionality on stock option repricings, and the software did not have, was really not built for that. So there's really a host of considerations to make. This is just to give you a flavor. And kind of, we're going to jump into the next polling question here related to kind of, how do you currently, account for share-based compensation expense?
All right. Yeah, and our second polling question today, how does your entity currently account for share-based compensation expense? Either A, manual calculations in Excel, B, software that handles only US GAAP, C, software that handles both US GAAP and IFRS, D, software that handles only IFRS, E, other, or F, I'm not sure of the capabilities of my entity's software. All right, if you just select the answer on your screen and hit the submit button, your polling question will be recorded. Give you about 10 seconds here to answer this one. All right, we're We're about 85%, about 5 more seconds here. All right, let's check out the results.
It's a lot of manual calculations out there.
Okay. Okay. Going on to the next slide. In terms of kind of valuation considerations, when you measure the award, when you have an equity classified award, you need to measure that, the grant date fair value of the award. So under US GAAP, regardless of your approach for, expense recognition, straight line versus accelerated, when you determine the grant date fair value of the award, you can determine that as a single award as an expected term equal to the average expected term of the vesting tranches, or again, treat them as separate awards corresponding with each vesting tranche, each with a different expected term. In reality, I think majority of companies, they're really treating it as a single award with an expected term equal to the average expected term. I've hardly seen anyone try to kind of apply the separate awards determination of grant date fair value. And of course, under IFRS, once again, you don't have that optionality. If you have graded vesting, service-based awards, you are really required to treat them as separate awards for each vesting tranche, using separate expected lives. So what are some of the kind of implementation challenges that you may run into? Here, really kind of the complexity that we see is whenever you have a first-time adopter of IFRS, and they have to go from having it, the grant date fair value using a kind of a single award to multiple awards, you need to really think about that when you determine the grant date fair value, you're kind of going back in time. You're going back in time at that grant date, and you need to use inputs, all the Black-Scholes inputs, volatility, risk-free rate, dividend yield, based on information that was available as of the original grant date. And that could be very challenging, if you're going back in time and adopting IFRS for the first time. It could be time consuming. So usually the other way around, if you go from IFRS to US GAAP, it's not going to be as challenging. In terms of forfeitures, that would be another main area where potentially most US companies, entities will end up having a difference with compared to IFRS. In terms of the history under US GAAP, in March of 2016, the FASB board issued ASU 2016-09. And with that ASU, the FASB board allowed entities to choose whether they estimate forfeitures or recognize forfeitures as they occur. Prior to that, it was required to estimate forfeitures under US GAAP. A lot of US companies, they took advantage of that new ASU, and when they adopted it, they did transition to using actual. At the end of the day, using actual is really simpler. It takes away kind of potentially another significant management estimate, and takes away all of that judgment surrounding the forfeiture rate. Under IFRS, on the other hand, once again, you don't have optionality that election. You're required to estimate forfeitures, and you revise that estimate in every subsequent kind of period. Now, when you think about kind of some of the significant considerations, implementation issues or considerations related to, do you align your forfeiture election under US GAAP and IFRS? something to keep in mind is, especially if you're a new entity kind of that doesn't have a lot of historical basis, it's a little harder to come up with a forfeitures estimate. It requires more judgment. Also, the fact if you go on, use that estimated approach election, you need to refresh that estimate each period. So that means you also need to have internal controls kind of surrounding that update as well. Especially if share-based compensation is material to the company's financial statements. So that could be kind of a cumbersome exercise to do. Sometimes also you need to consider the pool of your employees. Do you have different forfeiture rates for key executive management versus rank and file employees? So definitely estimating forfeitures just creates a lot of additional complexity and work. And using actual is always simpler and easier. So is aligning the two frameworks important to you, or are you looking for more simplicity on the US GAAP side? So those are just some of the things to consider. And that takes us to the next polling question. I'll let Chad take that away.
All right, and our third polling question for today's presentation: what methodology does your entity currently use to account for plain vanilla options with graded vesting? Either A, US GAAP, straight line method, fair value determination based on a single award, actual forfeitures. B, US GAAP, straight line method, fair value determination of a single award, estimated forfeitures. Or C, IFRS, D, other, or E, not sure. So if you select the answer on your screen and hit the submit button, your polling question will be recorded today. It'll be about 10 seconds or so to answer this polling question. Give you about 5 more seconds here. All right, let's check out the results.
Yeah, this is really not surprising. I really expected that, A is going to be the predominant here. I mean, that's the easiest and simplest accounting under US GAAP. So really not surprising to see that it's 41% of participants here. This takes us to another major kind of potentially significant difference between the two frameworks, determining the grant date. When we talk about equity classified awards, they're measured, you measure those at the grant date. That's the date where it's really important that you get this date correctly, the grant date, because you start recognition of the compensation expense. Usually the service period is the grant date. Now, under both frameworks, there's some considerations related to what exactly is that date, that service inception date. Now, generally for US companies, a lot of times it will be the date where the board approves the awards. But there could be certainly exceptions to that. In some cases, the board may delegate the authority to approve awards to management, where in some cases, if the employee started performing services earlier, those were approved by management, kind of that board approval could be viewed as being perfunctory, and you really should start recognizing compensation expense earlier than the board approval date. On the IFRS side, the guidance is, so under US GAAP, there's really very kind of, as you see it on the slide, I'm not going to read the whole thing, but there's very specific criteria that you need to meet in order to determine the grant date. Otherwise, if you don't meet that criteria, you don't get to recognize compensation expense until you satisfy those conditions, the grant date conditions. Versus on the IFRS side, it's less prescriptive. It's less prescriptive, and it's more likely that the service inception date, when you start booking comp expense under IFRS, could be actually earlier because you don't have all those conditions that you need to satisfy. So So, and again, we may be talking about timing difference of a few months between the two, where maybe under US GAAP, you should delay the recognition by 3 to 4 months when the board approved it, versus IFRS, you should start booking that comp expense a little bit sooner, 3 or 4 months earlier. But having to deal with that kind of difference could be, cumbersome for sure. If you have that difference it is possible. There are certain things that you can do as an entity to try to align those and avoid that diversity. You can, but of course, there's cost and benefit considerations surrounding those. I mean, under US GAAP, if you try to align your vesting start date with the grant date, that could help a little bit. For example, some employees might not like that. I mean, employees would prefer if they start vesting as soon as they get hired versus their vesting date starts when the board actually approves the award. So there's definitely those kind of cost benefit considerations. Do you want simpler accounting, or you want to do what's right for what the employees want? But you can review your existing employment agreements and letters to see what you're promising to employees, just to see if kind of are the key terms that establish understanding regarding the key terms of the award is established. So definitely things that you can look into, but it may be hard to perfectly align those. One other kind of area of potential difference is related to performance-based awards. When you think about performance-based awards, a lot of private equity groups, they love to give those awards that are 50% have a 50% performance-based vesting condition, where they vest upon a change in control event. Sometimes there may be, whether it's an IPO or just a change in control, or sometimes there might be a market condition as well, such as, returning some kind of a, return on capital, invested capital. But anytime you have a performance condition, such as changing control, typically the rule under US GAAP is you don't recognize compensation expense until it's deemed probable that the performance condition needs to be deemed probable. And a change in control is typically not considered probable until it actually takes place. So that means, for the most part, you're going to defer. You're not going to recognize compensation expense. It's just going to be a disclosure item under US GAAP. On the IFRS side, the definition, is really, you recognize those awards when they're expected to vest, which is, it's really a lower bar. It's more likely than not to vest. So you could have scenarios where you would actually book compensation expense for, an award that has, change in control, liquidity event kind of threshold. And that would be a difference between the two frameworks. I know I've seen it on some of my clients where this actually came up. In terms of upcoming pronouncements, kind of changes, there is a proposed ASU out there that the FASB published in September of 2024. Really, that ASU relates to if you have some share-based consideration payable to a customer in a customer contract where you're selling goods or services. Under the current guidance, if let's say, for example, you have a customer contract where if the customer hits certain volume of purchases, you're going to issue X amount of shares to them. You have basically a performance condition there, right, in this customer contract. And right now, there's a little bit of ambiguity between, you have two different topics. You have ASC 606, which deals with customer contracts. On the other hand, you have ASC 718, share-based compensation, which has its own definition of performance condition when it's probable. And then 606 it has definition on constraining revenues, kind of the transaction price to what's going to be earned. And those kind of concepts under the two topics don't perfectly align, where the FASB is proposing to update the definition of performance really performance condition. I'm not going to go more into detail. It's still a draft exposure, and there's certain other elements to it as well besides what I just mentioned. But that's kind of the main part. If you have those contracts, just be aware this is on the horizon. You may want to read through this proposed ASU. And we're going to go into the tax consideration section, and I'm going to turn that over to Dave at this point.
Thank you very much, Ovanes. Very much appreciate laying the foundation on the GAAP and the IFRS treatment of the compensation cost expense, because we need that information in order to determine the tax consequences. Armed with the book compensation and the awards that Ovanes just went through, the two areas that we're going to discuss is the tax accounting for stock-based compensation under U.S. GAAP, under ASC 718 and ASC 740, which is what I do, accounting for income taxes, and then under IFRS 2 for share-based payments, as well as IAS 12 income taxes. And we're sort of going to side-by-side compare the treatments between US GAAP and IFRS. So the key for US GAAP is to understanding the current and deferred income tax treatment of the book compensation expense and ultimately the tax compensation expense. So for awards that are expected to yield a tax deduction upon vesting or exercise, we're going to look to the applicable tax law. In this case, we're primarily going to be talking about U.S. tax law. And under U.S. GAAP, the concept of a temporary difference, which for the most part, the stock-based compensation will be a temporary difference. And as the vesting period occurs, we will be booking the book compensation expense with a related deferred tax asset through the P&L over that vesting period. Then, at the time that we have a vesting or an exercise, we will determine our tax deduction for that compensation. Many times, the comp will agree in total between tax and book, and what we have at the time of exercise is just in effect a reclass. We're going to book a current tax benefit for the actual tax deduction, and then we're reversing the deferred tax asset through deferred tax expense for a net tax expense of zero. But many times it's not zero, because the estimation that goes into the book compensation amount versus the true economics at exercise or vesting, where we're looking at the fair market value of the award at the time of vesting or exercise. And so we could have a tax deduction that exceeds the book deduction, in which case that additional tax benefit will get recorded on the income statement for US GAAP. If we have a tax deficiency, meaning that the cumulative book expense exceeds the tax deduction, then in effect we now have a naked deferred tax asset, if you will, that will have to get written off because there isn't a corresponding tax deduction for that full DTA. And that'll go through the P&L. For IFRS, it's a little bit different on the initial setup of the deferred tax asset during the vesting period, because we're not just looking at the book compensation expense. We actually have to try to forecast or estimate what the ultimate tax deduction will be. In this case, for example, based on the intrinsic value, the fair market value of the award at the time of exercise or vesting, less the strike price. We're constantly going to be estimating that intrinsic value at each reporting date and booking that amount as our cumulative booked DTA. So we do have here potential differences between GAAP and STAT for the amount of the DTA over the vesting period. Now, at the time of exercise, I mentioned the excess tax benefit on the GAAP side flows through the income statement. For IFRS, it actually goes to stockholders or shareholders' equity. That was the rule a while back under US GAAP before simplification, now causes to go to the P&L. IFRS still stays with the shareholder equity benefit for the excess benefit. But on the where we do have convergences on the tax deficiency, the write-off of the DTA will go to the income statement. Now, further, the tax benefit recorded as a DTA during the vesting period is ultimately, for US GAAP, trued up or down based on realization of the current tax benefit. Again, saying it another way, whatever the DTA is, that's going to come off through deferred tax expense, and we're going to record the actual current tax benefit. And so at that point, there may be a difference, as we just discussed. For stock options, the realized tax benefit, again, is generally going to be measured on the intrinsic value, the exercise date, the fair value of the award, less the strike price. For share-based award, the realized benefit is generally going to be measured by the fair value of the award on the vesting date. Under GAAP, at the exercise or vesting period, there's that potential for more volatility because of that difference ultimately in the cumulative book expense versus the total tax expense. Now, IFRS tries to anticipate that volatility by adjusting over the life of the share-based award the DTA up or down based upon, again, the ultimate intrinsic value on the exercise or vesting date, so that in effect you're taking into account that volatility during the vesting period. So as each reporting period comes, the estimated tax deduction is recalculated at the reporting date, which could cause more volatility from period to period as compared to the GAAP method. So IFRS will have less volatility at the end at the time of exercise or vesting. So you just need to be aware that you can get these differences between tax expense under GAAP and IFRS between the two. But generally, by the time the full cycle comes through the end towards vesting, they should generally equalize. It's just during the reporting periods intervening during that vesting where you can get that differences in volatility. So the different types of awards generally under the U.S. tax code, we have non-qualified stock options, where the tax deduction will be an exercise based on the intrinsic value. And at the same time, the employee will recognize taxable compensation. Whereas for book purposes, as we discussed, as the book compensation accrues, we'll recognize a deferred tax asset. For incentive stock options, this is meant to be an incentive for the employee to hold the option and then ultimately hold the stock for a period of time that we're going to talk about next. So generally, there's no deduction to the employer at the time of exercise, and no employee taxable compensation at exercise as long as they maintain the holding periods. So this really becomes an unfavorable permanent difference for the book expense because, again, unless there's a disqualifying disposition, there's not going to be a tax deduction. So a disqualifying disposition that we do see quite often with an ISO is the employee will dispose of the stock within 2 years of the date of grant of the option, or within 1 year of the transfer of the stock to the employee on exercise. So the employer tax deduction will be equal to the amount included in the compensation of the employee, and the amount included in the employee's compensation is generally going to be equal to the lower of the amount realized on the disposition of the stock or the fair value of the stock at the date of exercise, less the tax basis in the share, which is generally the exercise price. So because we didn't set up a deferred tax asset as the book comp was being accrued, we will have a favorable permanent difference upon disqualifying disposition. So a little bit different treatment with the ISO. Other types of awards, we have restricted stock awards, we have performance-based stock units. Here we're looking to what will be the fair value of the stock that the employee will be vested upon on the vesting date, and the employee will recognize that fair value of the award in taxable compensation at that time. However, as we discussed, the book compensation is going to be accrued during the vesting period. We'll have a DTA, and then at vesting, the DTA will reverse. We could get an additional tax benefit for increase in value or tax deficiency, as we discussed on the earlier slide. For phantom equity units, the tax deduction is generally going to be based on the actual cash distribution to the employee at the vesting date. The employee recognizes compensation for that amount of cash, whereas the book compensation was accrued during the vesting period for which we have the DTA. So there are a lot of common elements here with these plans, and we're just applying either GAAP or IFRS to the facts at hand, following, very importantly, the book, where the book comp is going and the timing of that comp for DTA purposes. Most stock-based compensation awards are considered deferred compensation plans, subject to Internal Revenue Code 409A, which needs to be very much considered in designing your plan and your plan documents. And it's very important that that work is done during plan design, because failure to follow these rules to the letter could cause a trip up, and penalties could be potentially imposed on the employer and employee in terms of accelerated comp for the employee or actual penalties to the employer. So it's important to consult with your equity comp advisors in designing the plans and knowing what the ERISA rules are, as well as the 409A compliance rules. So now we have a polling question. So Chad, do you want to do the polling question?
Yeah, thank you, Dave. And our fourth and final polling question of today's presentation: how does your organization typically manage the tax impact of stock-based compensation? Either A, handle it in-house through internal tax and accounting team; B, outsource to a tax advisory firm; C, combination of in-house and external advisors; or D, not sure, not applicable. So it could be about 10 to 15 seconds here to answer this polling question. If you select the answer on your screen and hit the submit button, your polling question will be recorded today. And as a reminder, if you have any questions for the presenters today, put them in the Q&A widget on your screen, and we'll do our best to follow up with you on those questions. All right, we're about 80% here. Give you about 5 more seconds or so to answer this polling question. All right, let's check out the results.
Okay, how does your organization typically manage? Well, it looks like it's a little bit even in terms of in-house accounting and tax being primarily a bigger item, as well as using the outsourcing or combination of in-house and external advisors. So pretty evenly spread, but I think there's some of you out there that are not sure how that's currently handled. That's understandable. It's not always 100% clear of who actually is handling. It may be very much a combination. So let's go on to the next topic. So one item and when we talk about plan design and plan provisions and flexibility, there is a provision out there. It's an employee election under Section 83B. It's really meant to be a benefit to the employees. And if the plans adopt the ability to have an 83B election that the employees can make, they have the ability to recognize compensation early where the value would be much less, closer to the award date, as long as it's unvested and there's a substantial risk of forfeiture, meaning that they really don't have the right to the award at that point. They can make an 83B election, and for most awards other than stock options, for instance, a restricted stock unit, you need to make the election within 30 days of the RSU being granted. However, for options, what's really key is the plan must allow the employee to exercise the option prior to vesting. So that doesn't always occur, but if that plan allowed it, it would allow the employee to elect to exercise within 30 days of the exercise date, which is again pre-vesting, and that allows them to recognize potentially compensation at a very low amount, and then the future appreciation will be later at lower capital gain rates. So be aware that this is out there and may be a benefit to your employees to make the 83B election. And of course, the employer's deduction would be, for tax purposes, equal to the amount that the employee includes. So if they make the election, potentially the company is going to get a lower tax deduction equal to the amount the employee will recognize in income. So everything we've been talking about, deferred tax assets and tax benefits, assumes that the deduction, there is a deduction. There is in the Internal Revenue Code applicable to publicly held corporations, as well as any company affiliated within that public group, that no deduction generally is allowed for employee remuneration, including stock-based compensation, with respect to any covered employee, which is generally going to be the top officers of the company, to the extent that such a remuneration for the year is greater than $1 million. So generally, a public company, you think about, they file with the SEC a 10K, their shares are going to be traded on the exchange. There may be publicly traded debt as well, or that may be the only, in some cases, traded security is the debt. And the covered employee will include the CEO, the CFO, and the next 3 highest compensated officers that are listed in the proxy. to shareholders, the annual proxy the shareholders use to vote. That is where you'll find those officers. Once an officer is a covered employee under the new rules that came out a couple of years ago, even if they no longer are an officer later in their career, they're still going to be subject to this rule that if their comp is above $1 million, it will be disallowed. So they can go into their retirement years where they're still receiving deferred compensation, still subject to this 162M limit. So it's something that you need, in effect, to monitor when you're thinking about recording your deferred tax asset, because it may be 5, 6, 7 years down the road that ultimately the taxable compensation will occur, and you kind of need to forecast, will that employee's comp be above $1 million when this award is exercised? If yes, then generally you're not going to have a deferred tax asset. And just be mindful, after 2026, 5 additional highly paid employees will be added to this covered employee list. So watch out for that. Just a couple of points. We're almost to the end here. Many stock-based compensation plans are issued by the parent company, covering the employees of the entire group, which may include a host of domestic employing companies as well as non-U.S. employers. So you need to take into account the various jurisdictions where these companies are operating, both within the U.S. and outside the U.S., to determine which jurisdiction applies to that entity, to determine will there be a tax deduction for the compensation. And where you have parents issuing the share awards for employees of subsidiaries, you need to have intercompany agreements in place that will govern how those awards will be settled between the parent and the sub. There may be resulting cash payments for contributions or distributions between the entities to settle those awards. And if you're doing cross-border, you may need to look at foreign currency gains and other transfer pricing implications. So it's important to plan in advance and make sure you have robust, understandable intercompany agreements that apply to these awards. In addition, for non-U.S. affiliates, again, we may not get a tax deduction if the U.S. isn't the employer for a particular employer overseas. There may not be a U.S. deduction. There may not be a foreign jurisdiction deduction. Some countries don't allow for these types of structured employee compensation arrangements a deduction in their country. So that's all very important in determining whether you will be booking a deferred tax asset. So again, plan design is going to be important to anticipate the multi-jurisdictional taxation that may apply in these contexts. So with that, I think we're at the end here. Any last minute questions? Chad?
All right. Thank you, Mark, Dave, and Ovanes for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide decks and handout window. If you participated as an individual and met all certification requirements, your certification should be available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this, as your feedback is very important to us. Thank you all again for joining us today, and we hope you'll join us again next time.